In March 2023, the financial world witnessed something that honestly many believed belonged to the history books. A bank worth more than $200 billion collapsed in less than 48 hours. Not a tiny regional lender buried in obscurity, but one of the most important financial institutions in America's technology sector. The fall of Silicon Valley Bank shocked investors, startup founders, economists and ordinary depositors because it exposed just how fragile modern banking can become when confidence disappears. What made the story even more fascinating was that the warning signs had been sitting in plain sight for months. Rising interest rates, risky balance sheet decisions, concentrated customers and social media panic combined into a perfect financial storm. For history buffs and financial enthusiasts, this collapse is, well, more than just a business story. It is a modern bank run unfolding in real time, powered not by crowds standing outside buildings, but by smartphones, venture capital group chats, and online banking transfers worth billions of dollars per hour. Understanding how Silicon Valley Bank failed also helps explain broader lessons about risk, greed, fear, and how quickly trust can vanish in financial systems. That matters whether you're an investor, entrepreneur, saver, or simply someone interested in how economic history repeats itself in new forms. Silicon Valley Bank became the financial engine of the tech startup world. Founded in 1983 in California, Silicon Valley Bank, or SVB as it's commonly known, carved out a unique niche. Instead of focusing on ordinary consumers, it specialized in startups, venture capital firms, and technology companies. If a small tech company received funding from investors, there was a strong chance its money ended up parked at SVB. That strategy worked brilliantly during the technology boom of the late 2010s, and especially during the pandemic era. Venture capital money flooded into startups at historic levels. Tech firms raised enormous amounts of cash, and much of it flowed directly into SVB accounts. The bank's deposits exploded from around $60 billion in 2019 to more than $190 billion by 2021. At first glance, this looked like massive success. But underneath that rapid growth sat the seeds of disaster. Banks make money by taking customer deposits and investing or lending those funds. SVB suddenly had far more deposits than it could reasonably lend to startups. So executives made a critical decision. They invested tens of billions of dollars into long-term United States Treasury bonds and mortgage-backed securities. Under normal conditions, those assets are considered relatively safe. The problem was timing. Rising interest rates quietly destroyed the value of SVB's investments. When inflation surged in 2022, the Federal Reserve began aggressively raising interest rates. This, well, triggered one of the fastest monetary tightening campaigns in modern history. Here is the crucial detail many viewers miss. When interest rates rise, older bonds with lower yields become less valuable. SVB had locked enormous amounts of money into long-term bonds during the low-interest rate era. As rates climbed, the market value of those bonds dropped dramatically. On paper, the bank suddenly carried billions in unrealized losses. This becomes easier to understand through a practical example. Suppose you bought a 10-year government bond paying 1.5% interest. A year later, new bonds start paying 4%. Investors would no longer want your older bond unless it was sold at a discount. Multiply that situation by tens of billions of dollars, and you begin to see SVB's problem. The danger became even worse because, well, most of SVB's customers were not ordinary savers with small accounts. They were startups holding massive cash reserves. Many deposits exceeded the federal insurance limit of $250,000. That meant customers had a powerful incentive to pull money out quickly if they sensed trouble. By 2022, venture capital funding slowed sharply. Startups that once raised easy money suddenly faced a tougher environment. Instead of depositing fresh cash into SVB, many companies began withdrawing funds to cover salaries and operating costs. This created pressure on the bank. Deposits were shrinking while the value of its investments had already fallen due to rising rates. SVB now faced a classic liquidity problem. To meet withdrawal requests, it eventually needed to sell some of those damaged bonds at heavy losses. In March 2023, management announced it had sold about $21 billion in securities at a loss of roughly $1.8 billion and planned to raise new capital. Rather than calming investors, the announcement actually triggered panic. Venture capital firms began warning their portfolio companies to move their money immediately. Social media, well, it accelerated the fear at incredible speed. Unlike those old-fashioned bank runs, customers no longer needed to line up outside branches. Billions could disappear with just a few taps on a banking app. Within a single day, depositors attempted to withdraw around $42 billion. That was, effectively, the end. On March 10, 2023, regulators shut down Silicon Valley Bank, marking the second-largest bank failure in United States history at the time. Authorities feared contagion across the banking system. If depositors at other regional banks panicked, the crisis could spiral into a nationwide financial disaster, a bit like what happened in 2008. To stop that from happening, the United States government announced that even uninsured SVB depositors would be protected. That move stabilized markets, but it also sparked debate. Critics argued it rewarded risky behavior and encouraged future recklessness. Supporters countered that allowing widespread startup failures could devastate the economy and spread panic through the banking sector. History enthusiasts will notice familiar patterns here. Financial collapses repeatedly involve the same human emotions: overconfidence during boom years, ignored warning signs, sudden fear, and, well, emergency government intervention once panic spreads. The collapse revealed lessons that apply far beyond banking. One of the biggest lessons from SVB is concentration risk. The bank depended too heavily on one industry and one type of customer. When the tech sector weakened, the entire system became vulnerable. Another lesson involves interest rate risk. Many businesses and individuals learned during the low-rate era to assume cheap money would last forever. SVB made decisions based on that assumption and honestly paid the price when economic conditions changed. There's also, a personal finance lesson viewers can apply immediately. Diversification really does matter. Whether you run a business, invest your money, or simply save for retirement, relying too heavily on one institution, one industry, or just one strategy creates vulnerability. For example, a business owner today might spread operational funds across multiple banks, instead of keeping everything in one place. Investors may want to rethink overexposure to trendy sectors during boom periods. And even ordinary savers can learn the importance of understanding how interest rates affect their investments. Finally, the SVB collapse demonstrated how technology has truly transformed financial crises. Bank runs once unfolded over days or weeks, but now they can happen within hours, all because digital banking and social media amplify fear at an absolutely unprecedented speed. The Silicon Valley Bank collapse will remain a defining financial story of the 2020s. The fall of Silicon Valley Bank wasn't caused by one reckless trade or some hidden fraud scheme. Instead, it was the result of interconnected economic forces, poor risk management, overconfidence during a boom, and panic during a downturn. That particular combination has appeared throughout financial history for centuries, from the Great Depression to the 2008 financial crisis. The difference now is speed. Modern technology accelerated every stage of the collapse. If you enjoyed this deep dive into one of the most important financial failures of the modern era, do subscribe for more serious documentaries and historical breakdowns covering economic disasters, forgotten events, and the decisions that changed the world. Share this video with fellow history and finance enthusiasts, and, well, stay tuned for the next story. History simply refuses to let us forget.